So let's start by discussing value investing. So look into this when the overall economy is not doing well and the markets are correcting. This is the time when high quality market leading companies are available at a discount. So you can think of this as the sale that happens once a year in some mall near you, where a shoe that you have been eyeing for a long time, which was normally priced at 10,000, is suddenly available at a 40% discount. So nothing has changed about the shoe. It is the same quality, it's the same brand, it serves the same purpose, but only during this discount or sale time it's available at a 40% discount. So markets keep moving from undervalued to overvalued phase with time. Over here, you can see value plotted against time, and this I would say this you can the midpoint of this range can be the true intrinsic value of a company, and the price keeps fluctuating between the value zone, sometimes pushing higher into overvalued and sometimes pushing lower into the undervalued zone. So value investors get active when this phase is playing out or this phase is playing out, and maybe here also when it is just right about the lower end of the value zone. And once it, in case it becomes overvalued, you would want to book out with the profits. Okay, so the best approach for value investing right now, as you are learning or you are still a beginner, is, or even later, is the SIP route. This really helps because you are buying in a phase where the markets are either correcting or moving sideways. So we cannot really pinpoint when the upward move will start. And usually during corrections, the volatility or the fluctuation in price is very high. That is why SIP gives us a great advantage, as you can buy over a period of time to absorb the overall volatility into the market, and it also gives you a lot of time to build positions, and it also gives market a lot of time to settle and begin the next upward move towards value zone and eventually maybe overvalued zone. So in case you want to invest, say, let's say 4 lakh into a company, what you can do is you can break it into small chunks of say 25,000, and keep buying every week. So that would be so into, we can say here, 4 8 16. So in 16 weeks we will be fully invested. So 16 weeks is approximately 3 months. 16 weeks or 3 months. So that will give markets enough time to kind of spend that move sideways, and then eventually start moving. So most of your position will be built around this phase. We'll take this up as an example also. So what would be the process that you would need to follow? First is to identify overall market cycle. So only if the market is in a corrective cycle can you look at value investing. Then after that, once you've identified the correct market cycle, you need to identify value opportunities, if any, are available in the market. So these opportunities will only come along in market leaders. In case of India, market leaders can be in the banking space. You can think of HDFC, ICICI Bank, SBI. In construction, you can think of L&T. In IT, you can think of Infosys, TCS. In consumption, you can think of Asian Paints, Pidilite. So next step would be to check the stage of the stock and only start when the stock is in stage 1 or stage 3. So as we had discussed the 4 stages, We only want to participate, we want to at least start our SIP when we see some signs of strength within stage 1 and stage 3. We'll also take this up as an example. Mark out the stop loss and begin your SIP. Review weekly to check price trend and mark out trailing stop loss. So every week you want to only buy if the stock is holding above your initial stop loss level. And as we are buying, as we are using the SIP mode, in case the stock breaks down, we can stop or pause that SIP and then wait for it to get back into the into a higher high structure. Also, you need to track company results to make sure that the company and compare them with other stocks within that sector to ensure that the company that we are investing in is still leading the market in terms of both sales as well as earnings. And then finally, if as your position keeps moving up, eventually it will reach the top end of the value zone or become overvalued, and that's where you have to look to book profits as the structure changes from stage 1 to stage 3, from stage 2 to stage 3, and eventually as it enters stage 4, you should be out of that investment. So let's take up an example. Over here I have ICICI Bank, which is a market leader in the banking space. I have not marked anything on the chart, so we'll do it together. So over here is the COVID fall that played out. So this is a clear stage 4, and then eventually the stock moved sideways for a long time and formed a stage 1. Now finally, this is where we started seeing strength, because this low was it was never broken, and eventually stock formed 2 higher lows and moved up. So this is the first time we formed a higher high, and but that this time the slope of the 30 weekly moving average was trending down. Even the relative strength was in a way trending down only. But from this point onwards, the relative strength started trending up, and eventually the 30 weekly moving average also moved up. So if we had to buy this stock, so this is the place where we could have started our SIP and marked this low as the stop loss. And now if you want to buy over say 15 to 16 weeks, so the first 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So for the first 15 weeks, the stock did not break the low, and we would have continued to buy. So we would have built our position with an average price of somewhere here. And now we just have to sit and trail it as per the rules that we had discussed earlier. So this is the first low that was formed, this is the high. And then eventually when the stock crosses this high, this becomes our trailing stop loss. Then we formed a new low over here, this is the high. So this high was actually never taken, and we formed a lower high and a lower low over here. And this is where we could have looked to exit our position. And then eventually the stock again starts forming. Over here you can see that it has again started forming a stage, and this is another good place. So this position basically, which started at around 400, eventual exit came at about 750. So that's almost a 90 or 200% move. And now again we are seeing that this is a market leader, and it's forming another stage which with equal lows and equal highs, and now it is breaking out. So this is the place where we could have started another SIP in the stock, marking this as our stop loss. Because over here you can see the relative strength is trending up, the 30 weekly moving average is just starting to trend up. So this is a favorable position to build another SIP. Now let's look at some more examples. So over here I have basically I'm comparing the market cycle along with the market leader stock that we might be looking at. So this is the COVID fall in Nifty 50, and this is the first time where the stock actually broke out and started to move up into stage 2. So this is our yeah, okay. So so while the Nifty index was getting out of stage 1, but still the 30 weekly moving average had not turned around. Tata Consultancy, TCS, had actually started moving much earlier and moved above the 30 weekly moving average and into higher high territories. So when the Nifty 50 was still below its all-time high, TCS was already in an all-time high zone. So this was a very favorable market leader which was moving before the market. And if we had started building an SIP as it was moving above the 30 weekly moving average somewhere here. So 1, 2, 3, 4, 5, 6, 7, 8, marking this as a low to trade. 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. So we would have bought somewhere with an average price of 2500 and then just traded the position by marking higher lows, and eventually it would have given us an exit somewhere here. Again, you can see here that this is in 2017, while the overall market was attempting to move up, Reliance was actually showing much more strength. This decline you can see was downward sloping, whereas Reliance was moving sideways. So this gives us a very good example of a market leader that was actually outperforming the overall market even while in a correction. So these stocks tend to do very well when the market cycle changes. So as it moved into a all-time high, market was still below that, and we could have started our SIP somewhere here, and by the time we would have finished, this would be our average buy price, and then all we have to do is trail it as price continues to move up. So this would have also given us about I don't know if we would have exited here. I don't have the extension on the chart, but still this would have given us about 100% return over a period of 1 year. Okay, so last example is L&T. This is again a market leader in the infrastructure space. So as it's moving out over here, you can see within stage 1 it is forming a higher low. That means that strength is coming. 30 weekly moving average is also trying to slope upwards. RS is also moving up from here. So if we start our SIP somewhere here, we would build an average price of about 1200, and then you can just trade your positions, and the exit actually came here. So about 16, 1700, which is also a decent 50-55% return. So that's how you have to use the SIP approach to invest in market leaders and slowly build positions and then continue to trail them till the stock enters the stage 4.
Now let's talk about growth investing. So you have to look into this when the overall economy is strong and the markets are stable. This is a time when growth stocks perform the best and tend to outperform the overall market. So for growth stocks to perform, they require a stable market, not necessarily very bullish, but just not there should not be any bearish sentiment or pressure. So growth stocks operate in their own trajectory. If a company is doing well, extremely well, and it's growing quarter on quarter, the stock tends to outperform the overall market by leaps and bounds. So all we need to ensure is that the market is not in a markdown or a downward contraction. And if the overall sentiment is neutral to bullish, we would be able to outperform easily, obviously in the right stocks. So for this also you can either use the SIP route or you can build lump sum positions, that is 50% on stage breakout and 50% if the trend is able to sustain itself over maybe a 2-3 week period. Again, let's highlight the process that we should follow. Check overall market conditions. As we discussed, the market should be either stable or rising or stable, but we should, in a markdown phase, we should avoid looking at growth stocks. Identify growth stocks using CANSLIM approach. So you need to find stocks that are consistently delivering quarter on quarter as well as annual growth. Then you have to look at something. You have to look at companies that are offering something new into the market and the other CANSLIM principles that we discussed. So this is a good way to identify the best growth stocks. Check if the stock is in stage 2 or is breaking out of stage 1 or stage 3. This is very important. It needs to technically set up to be able to perform. Review weekly to check price trend and mark out trailing SLs. This is what we've discussed before as well. Track company results. Growth needs to sustain, else price will drop sharply. So this is very important because growth stocks only do well till the time the market believes that there will be growth and they are able to deliver it quarter on quarter. So one off quarter is okay, but if you see a trend that's moving downwards, then it's a cause of concern. Book profits if the overall market trend and the stock trend shifts. That is, if the market starts to move into stage 4 or the stock starts to move into stage 4. Now let's take up some examples. So over here I have I'm discussing Deepak nitrate. Over here you can, so all this is from screener.in. You can see that it has 70% market share in sodium nitrate. So basically you can see it's a market leader within the chemical space, and it's now amongst the top 3 global players. Obviously it was not always the case, as you can see here that this is the annual P&L. In 2015 we were at this is in crores, so 1300 crores. Then not really much growth for the 3 years consecutive, and then 2018 onwards we start seeing some growth, and in 2019 the sales almost doubles. So this is where we should be interested in the stock, and this should also translate into growth in earnings. And over here also you can see the earnings has almost doubled. Now if you look at quarter on quarter, so you start in 2019, you start seeing consistency. This is the COVID fall, but then the growth again picks up. So you can see a clear upward trajectory in terms of sales, and if this is also reflected in terms of earnings. Yep. So over here you can see. So this is what makes it a growth stock. So it kind of flattened out at the end of 2021, but during this period from June up till June 2021, from June 2019 to June 2021, we can see that the profits actually doubled in a period of 2 years. So these are the parameters that we should be checking. And we also saw here that the company is a market leader and is competing at a global stage. So now let's look at the price chart. I've not marked anything, so we'll do it together. So the stock actually would have come to our attention somewhere in 2019 at the start of the year, where we saw 2x growth in sales as well as earnings. So in 2019, if you look at the stock somewhere here, we see that it had been in a stage for the past 1.5 years, So we can clearly mark this as stage 1, and then we will track the stock and look for a breakout from this stage. The breakout, actually the first attempt was made here, and we would have marked this level as our trailing stop loss, which was never violated, and this happened on the back of good volume in May of 2019. So this was after we had identified the stock based on fundamental parameters. So if we had started buying here, the first, if we were doing an SIP, we would have bought during this phase, and in case we were going with a lump sum purchase, then our first entry would have come here, and then we would look for this trend to sustain. It actually didn't sustain for quite some time, but our stop loss also was not taken out. And then finally, when the price starts moving up, this is where we can make our second purchase. So our average in this case also would be somewhere around the breakout level, and then we start tracking the stock. For the first low actually was the COVID low. So over here you can see that while the entire market was correcting, a growth stock did not correct much. There was long wicks at the bottom. These are signs of supply, and our initial stop loss was never taken out. All it did was to form a new low. Then the price continued to move up, and we would mark this as this moves. And this is the first time where 30 weekly moving average starts to flatten. Obviously the RS over here had already started to rise, and look at the out, you can clearly look at the outperformance of the RS, and somewhere here is where you would look at exiting because of the violation of the low. So all this is just a stage 3, but you don't know if it will convert into a stage 4 also. So this is where I would look to exit if my entry is around 260, uh, no, actually 300, and my exit has come around 2000. So over here you can see that the stock is almost uh, given you a 5x return. So these are the kind of returns that growth stocks generally tend to give if you catch the right one at the right time. So let's look at other examples. Here we have Tata Elxsi, which is from the IT sector, and we can see here clear rise in sales: 477, 558, 595, 630, 682, 726. So quarter on quarter growth in sales, so the trend is up. Similarly, the profits are also going up. So if you look at September 2019 to September 2020, the profits are almost up 30-40%. And then from September 2020 to 2021, another 50-60%. And then December, you can see that it's almost doubled from December 2019. So in 2 years, the quarterly profits have doubled. So these are the makings of a growth. So this is profit before tax. Okay, net profit also would be similar because the tax rate is consistent. So these are the makings of a growth stock. And in 2020, after the COVID correction, actually the IT sector was one of the first sectors that started to move up. Over here, you can see, I think earlier we had discussed that when Nifty 50 was here, IT sector was already moving into an all-time high, and Tata Elxsi was also the leading stock, and it had already moved into an all-time high. So if this was stage 1, it quickly moved into stage 2, and within 2 weeks only it made a new high. So if this was our first entry, this would be our second entry point, and we would have been in the position and marked somewhere like this as our stop loss. Then we saw that the stock actually moved, so this is about 1000. The stock actually moved, kept moving, and never really tested out the 30 weekly moving average as well. And still till date it has not given us an exit, and we are trailing again somewhere around 6500. So it's actually given us a 6.5 times return without exit yet. So these are the stocks that go up to become multi-baggers. Another one we have is Apollo Hospital. This also benefited from the pandemic, and over here you can see that before that only the sales were actually rising quarter on quarter. Then there was a dip, but then this is about 30% rise, so greater than 25% happened here. And then June over here you can see that this is about another 40 to 50% rise in sales. So this was the period, this starting from here, this was the period where this stock should have come into our radar because of this 25% hike in quarterly sales. And after a loss in 2020, we made a profit, and then the net profit also kept on increasing. So this is the phase where we would have wanted to participate in Apollo Hospital. So let's look at it somewhere in September 2022. So over here is when it actually broke out. So that means the fundamentals and the technicals were kind of validating each other. While Nifty was rising, Apollo Hospital had already moved into an all-time high, and this is the area where we can make our first purchase and then the follow-up purchase, and then just trail it as the stage 2 trend plays out. And then this is the first trail, second trail, third trail, fourth trail. The stock actually moved from about entry at about 1800, and the exit only came about the 4800 to 5000 mark. So this also gave us about a 3x return. So this, now you can see how growth stocks perform, and if you are able to catch them at the right time, they can easily, in the right market cycle, they will do extremely well. So once again, I want to reiterate the point of using stock SIPs and why it is much more advantageous, especially for beginners or people who have limited experience in the markets. So you can use SIPs for both value and growth, as we had discussed in some of the examples. So this is the SIP approach is especially useful when the overall market is weak. One second. When the overall market is weak, so instead of buying lump sum, break down investment capital into SIPs to counter market volatility. So in case you want to build a position of say 2 lakh rupees, we can break it down into 25,000 and build it over 8 weeks, or break it into 50,000 and invest it over 4 weeks. So that kind of adjustments you can very easily make if you use the SIP approach. In case the markets are in a very sustained bear market or stage 4, you can break your SIPs into even longer time frames. Drawdowns will be low and risk management is easier in case markets fall further. So in case markets fall further, you can just pause your SIP, and obviously you would have only built limited positions and not gone 100%. So this way your overall losses will also be, or drawdowns will also be much lower. There is flexibility of amount and time period. So in case market suddenly there is momentum and suddenly markets start to move up, you can increase the value of your SIP, or you can then, whatever is the remaining balance, you can buy a lump sum amount with that. So thus a lot of flexibility is available to you in this case. In case the stock is not performing, you can always pause and reassess. So it becomes, instead of holding on a loss making position on 100% of the capital, if you find that your stock is not performing, then by the time you would have only invested some part of your SIP. So it psychologically also, it makes it much easier for you to hold on to a smaller position and assess the stock unbiased based on how it is performing and how the overall market is performing. So now, as we close this section and also the course, there are some important points that I would like to discuss before we end. So let's start. Look around for stock ideas. Look at the products that you use every day. What is your place of work? Where do your friends work? What new products are available in the market? What are the companies that are launching them? Read magazines and newspapers for new product launches or companies that are moving on or companies that are changing or moving into the growth phase from a decline or a mature phase. So you will pick up a lot of ideas if you look around, and then now you know how to do your basic fundamental and technical analysis and look for opportunities in any stock that you may find interesting. Long-term outlook is beneficial. Now you've seen how the market cycles play out, and it is best for if you can ride the market as the various cycles play out to make the most of your investments. Mindset is key. So you need to learn to hold your winners. For this, you have to build conviction behind your ideas. So if you've actually done the research and found a strong growth or a value opportunity, you need to believe in it, and you need to follow or you need to stay in the position till either your stop loss is hit or there are some other red flags that emerge in terms of fundamentals. Basic knowledge of what is happening in the economy is important. So this is something that you need to develop, and it will be you will be able to do it with time. Uh, you can read business news and or get weekly updates on YouTube or some channels that you follow. So you need to know what cycle is currently playing out so that you know what you have to do in which cycle. Is it a growth stage? Is it a value stage? Or is it the time to just sit out and not really buy anything? You need to set correct expectations. Do not look for outsized returns, especially as you're starting out. First, learn to build a strong mindset, build strong processes, and the returns will follow. Keep portfolio small. So sizable amounts in a handful of name. This makes it actually easy to track and to follow the processes that you have developed. And also the returns tend to be much larger if you have a sizable amount in in a few stocks that are poised to do well. Do not fall for market myths. Always buy good quality. Don't run after stocks that are available at a discount during good market conditions. These are generally companies that no one is interested in. Always make sure you are in market leaders, and you should always be buying stocks on their way up and not on their way down. There is all now the now you've seen that there is a correct time to buy and a correct time to sell. So make sure that you are following this, because most people in the market tend to do the opposite. They will buy when everyone's selling and they will sell when everyone's buying. But now I think that you know better, and you will be able to time your entries and exits much better. So here are some reading recommendations that I would suggest for you to start with. So get these books, start reading them. If you have any doubts, you can always reach out to me, and we can discuss on certain topics, or I can help clarify in case something is not clear. So I hope you spend some time reading these, and in case you want to know more about any particular topic, you can always reach out and I will share with you multiple resources that can help you.